Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: corporation tax is paid by UK companies on their profits. Corporation tax starts with accounting profits, but tax law does not simply accept those figures without adjustment. When a company changes accounting standards, the way profits are measured can change significantly. Transitional rules exist to make sure income is taxed once and deductions are allowed once, even when accounting policies change. For corporation tax purposes, profits must be calculated in accordance with generally accepted accounting practice, known as GAAP. GAAP means either UK GAAP or UK-endorsed IFRS. Tax legislation then requires specific adjustments where the law permits or requires them. When a company adopts new accounting standards such as FRS 101 or FRS 102, adjustments often arise to accumulated profits and other comprehensive income. These adjustments relate to earlier accounting periods. However, companies are not permitted to reopen and amend earlier corporation tax returns simply because accounting standards change. Instead, transitional adjustments are brought into the corporation tax computation for the year of adoption. This approach prevents income being taxed twice and deductions being claimed more than once. Transitional adjustments reflect the difference between the old accounting policies and the new ones. They represent amounts that would have affected taxable profits in earlier periods if the new policies had applied at the time. These differences are calculated once and included in the corporation tax computation for the year of transition. In some areas, special tax rules can override the general transitional treatment. A practical example helps illustrate this. A company adopting FRS 102 may restate comparative figures and opening retained earnings. Any amounts that would previously have affected taxable profits are instead adjusted in the tax computation for the year of adoption without changing historic returns. Because transitional adjustments affect taxable profits in the year of adoption, they can also affect quarterly installment payments. If taxable profits increase, installments may be understated, leading to interest charges. If taxable profits decrease, installments may be overstated, affecting cash flow. Timing, therefore, matters. If transitional adjustments are identified early, installments can be revised to reduce interest exposure or avoid unnecessary overpayments. Common transitional adjustments arise when moving between accounting frameworks. This includes transitions from FRS 105 to FRS 101, from FRS 105 to FRS 102, and from IFRS to UK GAAP standards. Each transition can affect taxable profits differently, depending on the recognition and measurement changes involved. Accounting transitions do not just affect financial reporting. They can shift taxable profits into a single year, alter installment payments, and create interest risk if not managed properly. And this brings us back to the fact we opened with. Corporation tax is paid on profits, but when accounting standards change, the way those profits are measured changes too. That is why transitional rules exist, and why their timing can have real tax and cash flow consequences. What's a tax lover's favorite dance? The deduction shuffle.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.